All right, to discuss this further, we have Chakri Lokapriya, who's Chief Investment Officer Equities from LGT Wealth India, now joining in. Chakri, you did say that there is a fair amount of opportunity for Indian textile companies, electronics to capture a fair value by 2027 as well. I remember it was close to $7 to $10 billion when we last spoke. Now there is some sort of uncertainty and a fair amount of uncertainty as well. The certainty is that it does not extend beyond that 18%. The uncertainty is whether it's 10, whether it's 15, or whether it's 18. Given the current situation and the geopolitical tensions around, what do you make of the market setup and the benefit that India could accrue, or benefit that could accrue to India, specifically the sectors that you liked earlier, the PLI and the textile space?
Good morning. A lot has happened between the last time we spoke.
Exactly.
And the world has become a very fluid place. And India is an oil-dependent country. We all know that, with about 85% of its import. And as the rupee falls, and the rupee is falling for a reason. India has only about, let's say, about 25 days worth of oil reserves. So depending upon the length of this war and the Strait of Hormuz, etc., the opening of it is very crucial for India to buy oil at a reasonable price. Now, that has a direct bearing on the rupee, which has hit an all-time low. And now that has a direct bearing on whether it's textiles or PLI. Now, in the case of textiles, meanwhile, a couple of things have happened since we last spoke. One, the US government has changed some of its regulations to make the duties lower for imports from Bangladesh into the US. Therefore, Indian textile competitiveness goes down a little bit. Second, the Indian government, in its own wisdom, has taken away some of the subsidies that it gives to the Indian textile companies, and therefore that reduces the margins for the Indian textile companies in their exports because their margins come down. So again, the net of all this, I think a 15 or 18% textiles is better than where it was, but I don't think the margins will improve. Second, for the PLI, I think same thing, rupee falling will hurt their import costs. A lot of components are imported, and therefore that's as the rupee hopefully strengthens, you'll see some strength coming out.
By the way, the Nifty Bank has now moved into the red. It's almost a 400-point cut now from the highs of the day for the banking index. And since we are on that subject, Chakri, the one sector that is possibly insulated from all of this is the banking sector. Of course, if things go on for a prolonged period, there might be some cascading effects. But as of now, there has been this consensus view of PSU banks having deep value over their private peers. Do you subscribe to that view as well? And if so, do you bet on the smaller, mid-sized PSU names, or do you go on to the largest lender and stick to that and then find value in private names as always?
You said it right in terms of there is some amount of what you call collateral damage. It comes in various forms. One is, as long as this war and other conflicts, including the tariff uncertainty for the next 5 months continues, that means companies are, whether it's textile, jewelry, or some of the other sectors like electronics, they're all unlikely to do any capital expansion programs over the next 5 months because they're waiting for the dust to settle, which are where the rate's going to settle. So that implies lower credit uptake for the banks, whether it's PSU or private banks. And therefore, there is a second order, what you call slowdown for the banks as a result, while they're domestic in nature. Second, PSUs are kind of still better placed than the private banks because PSU will more benefit from the infrastructure growth of government spend on infra, whether it's construction of road, bridges, dams, etc. And therefore, I think PSU banks, whether large or small, whether it's an SBI or Union Bank, are well placed.
Well, Chakri, hi, this is Ritu. In fact, I'd go on to add that perhaps there is a direct repercussion because you have high crude oil prices that could mean a higher deficit and therefore higher borrowing and therefore higher yields. Wouldn't that hit some of the treasury gains, especially for these PSUs that have been leading the rally?
No, you're absolutely right. And just in the last 4 days, oil prices have gone up about nearly 15%. So that has, if the oil prices do not come down quite fast, then it increases the current account deficits. The rupee is, of course, falling. It also increases inflation. And all this hits the treasury gains of both of PSU banks and even private banks to a lesser extent. But it's just been 4 days, so hopefully, if the oil prices start their way down, it's good. Otherwise, if it continues for, let's say, for a month or two, then yes, there will be some amount of treasury gains hit for the PSU banks.
Chakri, short but insightful conversation as always. Thank you so much for sparing time and joining us today. Look forward to having you more often on the show.